Okay, as we mentioned, a little bit of nibbling for stocks after that sizable sell-off yesterday. The focus had been inflation, resetting expectations after the CPI report in the U.S. yesterday. We did get an inflation print in the U.S. today, the PPI number. Some making the argument that when you look at the producer prices, there actually are some signs of cooling inflation. But it's pretty clear that rates are going to continue going up, and investors have to make some decisions about how they want to strategize around that. And even as we speak, the NASDAQ is in the red to the tune of about 17 points. We talked about how investors are still shying away from some of those tech stocks. We saw that struggle between the bulls and the bears at the beginning of trading with Canada's Shopify, for example. Let's bring in David Nelson. He's chief strategist at Belpointe Asset Management. Thinks about these things day and night. In between playing songs on his guitar. David, nice to have you with us. I sometimes take shots at the pundits only because there's a lot of Monday morning quarterbacking that we see from people. And, if they knew that the stock market, at least with the U.S. stocks, were going to have its worst day in 2 years, maybe they could have told us before the sell-off yesterday. In other words, nobody really knows, but we got to kind of figure out how to surf all of this right now. So what have you been up to?
Well, the message yesterday was on inflation. It was worse than we thought.
Yeah.
And I think the Fed will take pause when they see those numbers and they look at key areas like rent, food away from home, car insurance. All of those things are in one way or another tied to the wage cycle. But from my perspective, I think what's likely to happen is we're going to bounce from one policy mistake to the next as the Fed will push too far. I think the Fed is going to try to adopt the playbook of past, and that would imply bringing rates up substantially. But we're already seeing some of the signs of it. You just mentioned Twilio. In the last couple of weeks, Peloton, Snap, Wayfair, Vimeo, JP Morgan, Microsoft, Bed Bath & Beyond, 20% of its workforce, and last night Warner Brothers cut 30% of its sales staff. That's starting to trickle through the economy. I think the Fed needs to understand this is not just a demand problem, it's a supply problem as well. Yeah,
and we'll talk a little bit more about some of those technology companies coming up. I want to talk about the swings. You talked about the swings. If you're I don't want to get too wonky here. People just want to know what's happening in the markets today. But if central bankers, and I'm not just going to talk about the Fed or the Bank of Canada, this is a global story. If they're getting slapped for not seeing the inflation storm that was coming, you're just one of many people who are warning about the lag in some of these moves and where it could ultimately take the economy. But there has been this united front for central bankers. We got to stay tough. We got to fight inflation. Do you feel that conviction runs so deep that they're ignoring any of this longer-term economic worry, or behind the scenes, are they actually just trying to get people's heads around the idea that the fight against inflation is a very real one, but if they see some real cool-down concerns coming up, that they'll have to pull the lever back a little bit?
Well, there's no question. It is a real fight for inflation, but you have a central bank on the one side, their job is very hard because they're draining liquidity. And on the other side of it, you've got government pouring it back in. And it kind of negates a lot of what's taking place. But it's like driving a battleship. You got to make the turn before you get there. If you wait until you can see it and make the turn, you're going to have an accident. And that's likely what's going to happen. We have to solve some of these other issues. Energy is probably at the heart of it. I think we all want a greener society, but any rational view of that has to understand that you need a baseload energy source. And that's not wind and solar or electric. It can't do it on its own. So you either have to go one of two ways. You got two choices. Either you can go with fossil fuel or you can go with nuclear as the base load. And I don't see us pushing towards nuclear, so that means fossil fuel energy is going to be with us a long time.
That factors into where you're thinking about investing right now as well, correct?
Well, it's energy, every time I come back here, it's always about a theme, and energy is certainly at the heart of that theme. We're going to have to invest in our energy infrastructure as well. But there's a reason why these companies are, I think, primed to do well into the future. The free cash flow yields are extraordinary. Just yesterday, you had Cheniere Energy raised guidance. A name that I own, Katira, that's a 9% free cash flow yield at about 7 times earnings. We can't turn off fossil fuels. As much as the Greens would like to do that, it's going to be with us for a long time, at least on the base load. I'll give you one anecdotal story. I'm a pilot, and I was flying up to a B-52 base up near up Rome, New York, and I passed wind farm after wind farm after wind farm, and the turbines were not turning. So we need other sources of energy.
That's helpful context. Take some videos next time. We'll work them into the show. You're a Renaissance man, David Nelson. So CTRA, LNG, those were a couple that you mentioned for people who want to play, more broadly speaking through, say, an ETF. XLE is one you mentioned. Outside of energy-related names, the other one you brought for the conversation today is Nexstar Media, probably lesser known in Canada, but tell us a little bit more about it.
Well, it's a name that I brought earlier in the year. There's a reason why this stock is up 29% when the rest of the market is in the toilet. This is an election year. And I don't care whether you're a Democrat or Republican, both sides of the aisle are going to be spending lots and lots of money on ads as we approach this election, and that's their wheelhouse. They sell ad time on their radio stations, and the biggest thing about it is the cash, a 16% free cash flow yield trading at 8 times earnings. Even if I'm wrong on the earnings front, I've got a lot of valuation support.